Okay, so I'm going to go through the pop quiz here on the first unit on investments. And again, at this point, my expectation is that you have watched the first two webcast videos with paper or electronic notes. You've reviewed your notes after you've watched those videos, and then you have actually completed the pop quiz number one questions before you watch this video. Again, I want to kind of warn you with this whole distance learning online content. It's really easy to maybe just skip ahead and just watch the videos and not do the behind the scenes work that's involved to really gain a mastery or understanding of the concept. So I want to encourage you to not just watch videos and just think you've learned everything. You have to absorb it, you have to apply it, and you have to think about it before it really becomes part of your total understanding. So I'm going to go over these questions. Again, I'm assuming you've already taken the practice exam and this pop quiz. I'm going to go over the answers here. Okay, so first of all, ownership shares in a corporation. And again, we might use the term equity securities. We might use the term equity securities being equity or an ownership. Security is an investment. So ownership shares in a corporation are just simply stocks or shares. We can use stocks or shares interchangeably. But again, when we talk about ownership, we're talking about if I own a stock, I own a legal portion or share in that company. Even though it's small, I own an ownership share in that company. Who owns Microsoft? Well, again, we talked about maybe Bill Gates owns, I'm going to guess, 9% of Microsoft, approximately, maybe more, maybe less. But for the majority, Microsoft is owned by thousands of ordinary people who are all shareholders or stockholders, using those two terms interchangeably. It's owned by thousands of people. So Microsoft is owned by stockholders, regular people. Verizon is selling, as an example. Verizon is selling for $52.73 per share. IBM is selling for $152.87. How is IBM stock performing compared to Verizon's? Well, you may be attracted to the bait of the big number versus the small number, and well, IBM is at 152, Verizon's at 52, so that's about 3 times greater, right? Wrong, because you cannot compare one company's stock price to another. Like I said in the last segment on the webcast, a penny stock, a stock that sells for less than $5, which is very risky, I might add, but maybe it has a trade value of 5 cents per share, and there are stocks out there like that. It could be outperforming and doing better than, or be a better investment than, a company that is selling for $1,000 per share. So you cannot compare one stock price to another. So the answer to this one might be you can't compare them, on number 3. A short abbreviation of a company is assigned by the stock exchange. If you remember in our last webcast, we looked at Microsoft, MSFT. And I think I showed you a video in the very first segment. MSFT is a ticker symbol. It takes us back to the ticker tape days where stock information was printed out via telegraph onto this tape, which ran continuously. And rather than type out the entire company name, it typed out an abbreviation of that company. I think V is Verizon, Starbucks is SBUX, and so on. So that is a ticker symbol, number 4. Number 5, the Dow Jones Industrial Average uses this many companies as a barometer to show how the stock market is performing as a whole. We've talked a lot about this so far. And again, if you go up to your window in your browser and type in DJIA, it'll tell you what the Dow Jones has done today. But it is a weighted average or a barometer of how 30 companies are doing at one point. Now, historically, and I maybe should have added this to my presentation in that first video, but way back in the 1890s, and you'll see I'm going to show you guys a movie. You're either going to watch a movie about the stock exchange, but originally people couldn't tell from one day to the next how the stock market was doing. Some stocks were up, some were down the next day, some were up, some were down. And so the guys that came up, Dow and Jones, who came up with this, they had a daily stock letter. They decided, hey, let's create an index. And I believe it started out as 15 companies. It's either 15 or 20. I kind of forgot that. But anyway, started out with just a few companies. They said, let's take these companies, let's make a weighted average called a stock index, and let's publish that every day to see how the market as a whole is doing. So now we have 30 companies which go into the Dow Jones, which again is a weighted average of how those 30 companies are doing and how their stocks overall, those 30 companies together in one big bundle or bucket, or call it a recipe, so to speak, are doing as a whole. I just mentioned this term here. The figure that Dow Jones Industrial Average is a stock index. Again, a stock index. There's the Dow 30. There's the S&P, the Standard and Poor's. The S&P 500. It's an index of 500. There's the Russell 2000, which is 2,000 stocks. And then there's the NASDAQ as the four main stock indexes that are out there right now. But again, a stock index is a measurement of how a group of companies are doing. And can you make sure you get that into your notes, electronic or paper? This seems to be a concept, this whole stock index thing, because to me it's very important, because when you hear on the news, today the Dow Jones Industrial Average was down 900 points, that should mean something to you. So when we say stock index, we're not talking about dollars, like the Dow Jones, the last video I showed, it was like 21,000 something. That's 21,000 points, not dollars, but points, and it is a combined weighted average measurement of how 30 companies are doing. It takes the noise out of the stock market of all these different companies going up and down, basically saying, here's one number which shows us how the market is doing as a whole, a stock index. A per share amount, usually declared quarterly, that's every 3 months, where a corporation shares its wealth with its investors. And we did some calculations on the last video, and if you recall, it was February 19th, prior to me making the video, that Microsoft, which was the company we were looking for, they declared a 51-cent per share dividend. And again, the board of directors, the people that give the big oversight to the company, are the ones that declare that. All right. Then we have spreading your risk across multiple stocks. Didn't really talk about that too much in our previous discussion. But also in the stock market video, there's this dude called Harry Markowitz, who was a professor of economics at the University of Chicago, and he decided that, hey, it would be better to take all your money that you want to invest and to spread it out across multiple stocks rather than put it all in one company. This is called diversification. Diversification. All right? Can I write an answer down there? I don't think I can. But anyway, stock diversification. So stock diversification, that's how that looks like, is when, again, you're spreading your risk across multiple stocks. And you're going to be doing some play and pretend investing here. Again, spreading your risk across multiple stocks, diversification. And again, hopefully the companies of yours that are increasing or going up in value are offsetting the ones that are going down in value. Question 7 and question 8 kind of work together. And again, this is another term that I don't think I did very good. Actually, so I should say question 8 and question 9 work together. A group of stocks. And I think it's because we haven't done the Investopedia piece yet. So don't freak out like, Reardon, you didn't talk about that. Well, I will. All right? A group of stocks. This would be called a portfolio, kind of like an art portfolio or a work portfolio or whatever. It is more than one stock, a group of stocks. Now you're going to be investing in 5 stocks. That'll be a stock portfolio of 5 stocks. And when you have a portfolio or a group of stocks, you are by definition spreading your risk across multiple stocks. Okay. A girl was 10 on her last birthday. When it will be 12 on her next birthday? How is this possible? This has nothing to do with personal finance. Just logic, right? Well, can you guess what the deal is there? It's her 11th birthday. Which, by the way, yesterday was my birthday. You notice how I said because I don't want you to know. I'm 50 something. Okay, that was yesterday, March 31st. Anyway, John bets Tom $100 he can predict the score of the football game before it starts. Tom agrees, but loses the bet. Why did Tom lose the bet? Because the score before the game starts is 0-0. Oh, yeah, another logic question. Okay, I hope that was enjoyable. And again, if you have any questions on any of this stuff, Reardon, I don't understand what you're talking about here. This is confusing to me. Whatever. Send me an email. I can set up a one-on-one meeting. Whatever you need, I'm here for you. All right? Moving on, we're going to get into Investopedia and investing our money. Have a good day.